Hey, I'm Jason, and this is Supply Demand Daily, where I tell you what we learned about the economy today. I'm going to get started with a news article, but what are we going to talk about today? The S&P Case-Shiller National Home Price Index came out today. Unfortunately, it's on a 2-month lag, so we're looking at data from March, 2 whole freaking stinking months ago. That kind of sucks. But anyway, that's the data that we have. And we have the FHFA Home Price Index as well. We got the Chicago Business Barometer, which tells you about the condition of manufacturing firms in the Chicago Midwest area, I think. Consumer confidence was down a little bit in April. Excuse me, I think we're talking about May. Yeah, we're talking about May. Consumer confidence was down in May, and there was a little snippet of that report. This is from the conference board that I want to discuss about the labor market specifically. But I'm going to get into some news here for just a minute. So this is an article from Bloomberg, and it's titled, "Europe's Move Against Putin's Oil Maybe It's Last for a While." And this is going to make sense as I read. European Union leaders overcame weeks of division to clinch a deal on partially banning Russian oil, but calls to target one of President Vladimir Putin's other big moneymakers, natural gas, are opening new rifts in the bloc. In the hardest-hitting measure targeting Russia's lucrative energy sector, the government chiefs agreed to pursue a ban on the purchase of seaborne oil and petroleum products from Russia, with a temporary exemption for pipeline crude. Most of it is transmitted through pipelines. While the details must still be hashed out, the deal prepares the ground for a sixth package of sanctions to punish Putin for invading Ukraine. I'm sure he's quaking in his boots. Quote, "Yesterday proved that the EU was able to maintain unity in the face of Russian aggression," Czech Prime Minister Petr Fiala told reporters on Tuesday, the second day of a leaders' summit in Brussels. Quote, "The talks were pragmatic and went faster than expected, which is a strong message for Putin." I'm sure Putin and his advisors are probably sitting around that long table they always depict in the Kremlin, just absolutely losing their minds. Sorry, it's just these political words like strong message. I mean, it's like, what is that? What is that? So anyway, with ambassadors set to discuss the package Wednesday, Latvian Prime Minister Krišjānis Kariņš, I don't know if I pronounced that correctly, said the bloc must push ahead on gas, but he noted the bigger challenge because supplies of the fuel, on which EU members like Germany are heavily dependent, are harder to replace. Quote, "You can put oil in lorries and move it around easily," he told Bloomberg TV. "To move gas, you need specialized equipment," and that is absolutely true. In the weeks that the EU wrangled over oil, Poland and the bloc's Baltic members argued that until gas is included, sanctions won't go far enough. But the members are split on discussing this in a next seventh package, with some leaders seeing quick action unlikely. Quote, "This package is a big step forward. We should pause it right now," Belgian Prime Minister Alexander De Croo told reporters, calling a gas embargo, quote, "way more complicated." It does seem that way. About 2.3 million barrels a day of Russian crude heads through a network of pipelines and ports, while Irish Prime Minister Michael Martin called Tuesday's late-night agreement a watershed moment for the EU's dependence on Russian energy. He made it clear that consensus on gas would be harder. Slovenia's Janez Janša wished his colleagues, quote, "good luck on finding a solution," while Estonia's Kaja Kallas, who has been one of the bloc's strongest advocates for stricter measures against Putin, was also cautious. Let's see if there's anything. Quote, "I think that gas has to be in the seventh package," Kallas said, "but I'm realistic as well, and I don't think it will be in there." The sixth package envisions covering more than 2/3 of oil imports from Russia, cutting a huge source of financing for its war machine, European Council President Charles Michel said in a tweet. Once officials and diplomats agree on the technical details, the sanctions must be formally adopted by all 27 nations. The European Union Commission has proposed to ban seaborne crude oil 6 months from adoption, while refined petroleum products will be halted in 8 months. So that puts us at early 2023 and, February, March 2023 for these things to come into effect. Now, if I can get out of the way, did the prices of these commodities mentioned in this article respond to this news very much? So Orange line, we have Brent oil, which is more common in Europe. That is the benchmark contract for Europe. And we do have the WTI to Brent spread is often mentioned in oil markets. And the white line is WTI, which is the benchmark for the U.S. WTI stands for West Texas Intermediate. And we did have the spread diverge a little bit. It increased more than is typical. We saw a similar departure of these two lines in the March surge of oil prices back when the Russian invasion of Ukraine was still relatively young. But nothing crazy here that I can really tell. Both prices went up a little bit, and but there hasn't really been a huge departure from trend. Only time will tell in the coming days how the oil market views this policy. And then moving into natural gas, this is the Dutch TTF contract, which is the benchmark in natural gas for Europe and how Europe burns natural gas to get electricity. So this is priced in megawatt hours, so the amount of natural gas that you need to create a megawatt hour of electricity. And we saw virtually no movement here today. We're still sitting at 94 euro a megawatt hour of natural gas, which is kind of a weird unit when you think about it. But so the natural gas market at least seems to agree that it's probably is kind of unlikely that the EU is going to agree on a gas ban. So that's all I have on the energy front. Let's move into the Case-Shiller index. It was an absolute blowout. Home prices went ham in March. I mean, absolutely ham. So we're looking at a rate of increase. This right axis here is not year over year, it's month over month. So I'm talking about the blue line here. This is the monthly rate of increase. It's month over month, and it's over 2%. So if you take that and you had the same monthly rate of increase for an entire year, you'd be looking at 24% on a yearly basis, which is absolutely insane. So again, I have the index level, or these yellow bars back here. You can clearly see the trend start to pick up in late 2020 going into 2021, and it's honestly impressive. It's pretty crazy, and this is the biggest month-over-month rate of increase in all of the years going back to 1987 that data is immediately available for this index. You can actually get it all the way back to 1890, and I'm going to do a little bit of looking into that here pretty soon. But in those 35 years immediately available, this is the biggest by far month of increase, and it beats all of the years of the early 2000s housing bubble, which was the main comparison leading up to this little episode that we've seen here. And according to FHFA, the mountain region of the United States, which I'll show here in a second, leads the pack among different census regions for the amount of home price increases in the last 2 years, going back to January of 2020 at 46%. So home prices in the mountain region on average have gone up by almost half. So $300,000 house in 2020, add 150 to it, and there's the new price. It's pretty crazy what's going on in the real estate market these days. So this is the mountain region, and then here's where I'm at, west, south, central. I would call that the best. And then we have South Atlantic, Mid Atlantic, etc. And these are Census Bureau regions that the Federal Housing Finance Agency, which happens to be the chief regulator of the company that I work for. That's what FHFA stands for. The mountain region is leading the pack, and I've shown just how ahead they are in this chart here. The blue lines are the different regions, and the red line is the U.S. as a whole. This is simply a chart showing the rate of increase indexed to 100, or the index level, but set at an index to 100 in January of 2020. So you can infer by the end of this chart, if this is sitting at 146, then that means prices have gone up by 46% over the last 2 years and 3-4 months. So the west north central region, which if I could pan back to the map, is here. It's basically made up by the Midwest, your Nebraska, your Kansas, your South Dakota, your North Dakota, etc. That was the slowest rate of increase at a whopping 29%. So there's not a whole lot of daylight between the two. You're still looking at almost a third increase in home prices, even in the slowest increasing region. So it's like I said, it's pretty crazy what's happening. And I'm surprised to not see a slowdown in the rate of home price increases because, as I have talked about before, the activity in the housing market is definitely slowing down. We see fewer home sales each month, and we see more price cuts, and we see a drop in pending home sales. And that has been the case for the better part of 6 or 7 months now, if you pay attention to the National Association of Realtors data, which I did some analysis on last week, and you can go back and watch those videos if you so desire. But the housing market, in terms of quantities sold, definitely seems to be slowing down. So to see not even a slowing in the rate of increase in March is pretty surprising. Now, it'll certainly be interesting to see what happens for the April data, because existing home sales, that is the sale of, for lack of a better term, used homes that were not built this year, dropped by 22% on the month in April of this year, as we saw last week. And so I'll be very interested to see how the FHFA index and how the Shiller index behave when the April data finally comes out in, it'll be about a month from now, unfortunately. So, but something to put on your radar there. Now, talking about the consumer confidence index, this is different from the University of Michigan's Consumer Confidence Index, or Consumer Sentiment Index is what they call it, that I reported on last week. And you'll notice that this particular one has not fallen off an absolute cliff the way that the University of Michigan index has. And a lot of that has to do with different samples and different type of formulation. But it has certainly been dropping ever since about the middle of 2021, mid to late 2021, which does kind of line up with some things that you've seen in financial markets, with the stock market having basically peaked in December, as it seems. I know I'm going to live to regret that quote, but anyway. And some other different kinds of dynamics that we've seen ever since basically the start of 2022. And but one thing that I did want to point out is, let's see if I have the right slide pulled up. It's only down slightly by 2 points, but okay, so a couple of things here. One is the gap between expectations and the present situation. They have a present situation index in terms of like general business conditions for, and this is the blue line, and then this expectations line basically asks consumers who are surveyed what they view the condition of the economy and the job market and all those kinds of things is going to be about 6 months down the road. And when you have a slow recovery, so if you notice in the first several years of the recovery from the Great Recession, there was a time when expectations were pretty high above the current situation, and then once conditions really start to improve and the labor market comes back, then you see these two lines cross, and we get and the gap, sort of reverses direction. But the expectations indicator here has definitely dropped in the same way that it did prior to 2008. It just sort of edges along, and then we get these, so we're below the level of the pandemic. Actually, we're below the level of the pandemic recession in terms of the expected business and labor market conditions in the next 6 months, which is interesting. The share reporting that jobs are hard to get actually went up by 2 points from 10.1 to 12.5%, and 51.8% of consumers said jobs were plentiful, which is actually a little bit less, about 3 points less than last month, than the month of April. Okay, so the Chicago Business Barometer, given what we've seen in all of the other sort of manufacturing, purchasing managers indices, all the manufacturing conditions, business indices, I was kind of surprised to see this come up at all. But as you can see, it's still kind of riding on a downtrend here that started in the middle of maybe the mid or early to mid 2021. And so we did see a little bit of a pickup here. A lot of these businesses are are still reporting that materials are hard to come by, that there's shortages of supply, and that their prices are rising. The employment index, so this is the share of businesses who are talking that they are increasing employment, is sub 50. And when we look at these types of indices, the reason that there's a big dashed line here is because the sub 50 values are considered contractionary. As you can see in the two last major recessions that we've had, this index has ridden below 50 quite significantly. So for the employment index to be below 50 is definitely a signal for the job market, and definitely a signal for the overall health of these businesses. So it'll be interesting to see how this continues to develop in coming months. And the biggest challenges that were reported by managers, these are in the special questions category on the May survey. We got increasing cost was about 80%, delivery and lead times just under right around 70%. You got materials shortages, labor shortage, which was a lot less than it was the month before. Declining economic sentiment, surprisingly only 21% there, and then an increased demand. What's interesting is that only 8.5% of respondents, so purchasing managers in the manufacturing field, responded that one of their chief concerns was increasing demand. So that's interesting and kind of shows maybe a slowdown in the activity in the demand for their products, which is not necessarily a good sign, even though they've had trouble coping with that in recent years with all of the inventory hangups and things like that. Is the deglobalization trend a little bit overblown? So in light of the pandemic and supply chain issues, particularly with China, in the month of April, they asked these purchasing managers about their plans to reevaluate their supply chains on a country-specific basis. And it was interesting to see that while 67.5% had revisited their key suppliers, only 17.5% of respondents, again, so purchasing managers in the manufacturing field, had responded that they were actually revisiting their supply chains on a country-specific basis. And so what that tells me is that maybe there is not so much of an appetite for deglobalizing, that is, reworking trade routes and supply chains so that there is more stuff made within the U.S. or within countries that there's less of a likelihood of running into trade spats with, right? That would be deglobalization. So it seems like, just based on that one question, and you would really have to do a lot more thorough analysis and research and grab from a lot more data sources to form a complete conclusion as to if the world, how much the world is deglobalizing. But based on this one metric, 17.5% is, certainly not a majority, but, it's less than 20%, so, less than a fifth. So it's not as much as I would expect to see, given how much there is, how much coverage there is in the news and the business news about deglobalization. So just another thing to throw on your radar there. And then lastly, what are we going to be talking about tomorrow? We're going to go through job openings. We're going to talk about quits. The job openings and labor turnover survey comes out tomorrow. And there's going to be reports on construction spending, a really big industry here in the U.S., and motor vehicle sales, which is going to be interesting because of this has been a really hot topic in recent years, because it's actually been a seller's market in used motor vehicles for the first time in basically ever. So, with used car prices and new car prices going up so much. So I'm going to cut it just under 20 minutes here, and I do want to thank you for joining me in Supply and Demand Daily. I hope to see you back here tomorrow, and I'll have some good data to look at for you, and maybe some more news and stuff like that. If you got any feedback for me, drop me a comment on YouTube, or you can DM on Instagram, or send an email and all that good stuff. I'd love to hear what you have to say about the show. And with that, I will talk to you later and wish you a happy Tuesday. Thanks very much.